You placed the trade. The analysis made sense. Price moved in your direction for a few candles and then reversed, hit your stop, and immediately went back the way you originally predicted without you. If that's happened to you, the problem probably isn't in your entry. It's not your indicator. It's something that went wrong much earlier, the moment you first learned what Forex is. Because the way most people are taught, this market quietly installs a broken mental model. And that broken model is what makes everything afterward. Your entries, your exits, your risk, your emotions, harder than it needs to be. So let me rebuild this from the ground up. Not pips, not lot sizes, not trillions in daily volume. You can Google that in 30 seconds. What I want to do instead is show you what Forex actually looks like when you are sitting in front of a live chart trying to make a real decision, because that's where the standard explanation completely falls apart. Let's start with the first thing that goes wrong. When someone tells you Forex is buying and selling currencies, your brain reaches for the closest analogy it already understands. And for most people, that analogy is shopping. You buy something cheap, you sell it when it's expensive. You own it in between. That instinct seems harmless. It's actually the root of some of the worst trading habits beginners develop. Think about what shopping psychology does to you inside a live trade. You buy Euro USD at 1.1814. In your head, you now own something, and because you feel like an owner, you behave like one. You hold on, you wait for the price to come back. You refuse to sell it a loss because that would mean admitting you made a bad purchase. You start averaging down, adding to a losing position because the product is now cheaper and that feels like a better deal. But you didn't buy euros. You don't own anything. You opened a speculative position, a temporary bet on a price difference, funded largely with borrowed money inside a market that moves 24 hours a day and doesn't know you exist. An owner waits, a speculator manages. An owner hopes, a speculator defines in advance what has to happen for the trade to stay valid and what would do it wrong. That shift from ownership thinking to speculation thinking changes everything. It changes how you set your stop loss. It changes how you can react when price moves against you. It changes whether you survive your first year. And almost nobody explains this to beginners, because almost every introductory Forex video is too busy explaining what a pip is. If you have ever had a losing trade wait too long and couldn't explain why, this is probably why. Not greed, not stupidity, a bad mental model you didn't know. You bad. Now, let's go one level deeper, because even after you fix the ownership problem, there's a second misconception that's just amazing. When you look at a chart for the first time, your brain sees direction, up or down, bullish or bearish. And it assumes the job is simple. Figure out which way price is heading. Get in, ride the move. That feels right. It's also the reason most beginners enter at exactly the wrong moment. Here's what I mean. Have you ever been in a situation where your analysis was correct? Price did go in the direction you expected, but your entry got stopped you first. You were right about the move and still lost money. It felt personal, almost like the market was targeting you specifically. It wasn't personal, but it wasn't random either. Price doesn't just move in a direction, it moves through a process. And the single most important part of that process, the part beginners almost never see, is the sweep. Before a real move begins, price frequently moves against the expected direction first. It dips below a support level or spikes above a resistance zone, just enough to trigger the stop losses sitting there, and then reverses. The move that takes you out is the move that fuels the real trade for someone else. When I first started understanding this years ago, it changed how I read every chart. Because once you see it, you can't unsee it. The market isn't just moving, it's hunting for liquidity before it moves. Beginners see direction, experienced traders see a sequence. Sweep first, structure shift second, move third, same chart, completely different reading. And those different readings produce completely different outcomes. Let me make this concrete so you can see exactly how this plays out on a real chart. Tuesday morning, London just opened. GBP USD has been sitting in the tight range through the Asian session. Let's say between 1.3378 and 1.3371. Quite compressed, nothing happening. Within the first 15 minutes of London, price pushes above 1.3407. A beginner buy at 1.3398. A stop loss just below the range at 1.3360. Price climbs to 1.3410. They feel good. This is working. They got excited. Then it stalls. One bearish candle, then another. Within 50 minutes, price is back inside the range. Within 90 minutes, it's at 1.3360. Well, below the entire Asian session low. The beginner got stopped out, confused, and is now watching price run 60 pips in the exact opposite direction. What happened? London swept the buy-side liquidity above the Asian high. All those breakout entries, all those buy stops sitting above 1.3398, they got triggered, absorbed, and used as fuel for the real move, which was down. Now, here's the part most videos leave out, the part that actually makes this useful. Knowing the sweep happened isn't enough. The question is, what should you have done differently? And the answer isn't don't take breakouts. That's too simplistic. The answer is a decision filter. And it's simpler than you think. After a sweep, after price takes out a key high or low, don't enter immediately. Watch what happens next. Does price aggressively reclaim the range? Does it close back below the swept high with a strong bearish candle? That reclaim, that shift in structure after a sweep is your actual signal. The breakout was bait. The structural shift afterward is information. So the sequence is sweep happens, you pause, you wait for price to show its hand. If it reclaims the level, it just broke and it stands and starts displacing in the opposite direction. Now you have something. If it just keeps going through the breakout, fine, you missed it and it's okay. You preserved your capital and stayed out of a trap. That one filter, wait for the sweep, then watch for the claim, would have saved most beginners from the GBP USD scenario I just described. Not every time, nothing works. Every time, but it shifts the odds in a way the direction first thinking never can. Now, I want to zoom out because there is a bigger misunderstanding underneath all of this, and it's the one that connects everything I have said so far. Most beginners think Forex is hard because they need to learn more indicators, more patterns, more strategies, more YouTube videos. They think knowledge is the bottleneck. It usually isn't. In my experience, the traders who struggle the most are not the ones who know too little. They are the ones who know just enough to be dangerous. They can identify a support level, but they treat it like a wall instead of a zone. So they get stopped out by a wick that passes through it. They know about risk reward, but they aim for 1:3 on every trade without asking whether their setup actually delivers that ratio over a meaningful sample. They have heard about discipline, but they think discipline means never losing, when it actually means losing wealth. Slightly wrong is worse than completely wrong. Because completely wrong makes you cautious. Slightly wrong makes you confident. And confidence within a flawed model is how accounts blow up. So, what should Forex actually look like in your head? Here's the frame I wish someone had given me years ago. Forex is a probability game. Your job is not to predict what price will do. Nobody can do that consistently. Your job is to identify situations where the odds likely favor one outcome over another. Size your position so that being wrong doesn't hurt you, and then repeat that process hundreds of times. A beginner asks, is this trade going to work? An experienced trader asks, is this setup out of my age? And am I positioned correctly? If it doesn't, that's a completely different question. And the trader who asked the second question is the one who is still in this game 3 years right now. The market isn't hard because the concepts are complicated. You can learn pips, lots, leverage, and chart patterns in a week. The market is hard because it constantly asks you to act against your own instincts. It asks you to take a loss calmly, to sit down, to sit out when you feel like you should be trading, to hold a winner when your gut screams to grab the profit, to stay small when every part of you wants to go big on a setup that looks perfect. That's not a knowledge problem. That's a human problem. And the traders who survived long enough to become profitable are the ones who figured that out, who stopped trying to learn their way out of a discipline problem and started building the habits that let their age play out over time. Not over the next 3 trades, over the next 300s. The patience doesn't make good Instagram content. It doesn't sell courses. But after more than a decade in this market, I can tell you it's the only thing that actually works. So if you are early in your trading journey, I want you to take one thing from this video. Not a strategy, not a setup, just this. Check the mental model you are carrying into every trade. Are you thinking like an owner or a speculator? Are you trading direction or reading structure? Are you trying to be right or trying to manage ask? Are you trying to be right or trying to manage risk? The answer to those questions will decide more about your trading future than any indicator ever will. Drop a comment. What was the first thing you believed about Forex that turned out to be completely wrong? I am genuinely curious because in my experience, that answer tells you a lot about where the trader is headed.